What's up, guys? Today I wanted to share a little bit from The Intelligent Investor, a great investing book and Warren Buffett's mentor and teacher's uh, most well-known book, and also Warren Buffett's favorite book. So earlier today I was just thinking about this book and I wanted to dig into it again as it's been a little while. So I recently flipped to my first tab of many, as you can see here, and I really enjoyed just reading this little passage. So I'm just going to share a little bit. So this first part just kind of talks about Benjamin Graham and his thoughts on speculators versus investors. And this is actually the commentary on chapter 1. So something about this book, The Intelligent Investor, the definitive book on value investing, written by Benjamin Graham, the revised edition. This one has preface and appendix by Warren Buffett, and it also has commentary by Jason Zweig, who is a Wall Street writer and a stock market investor himself. If you've read this book before, you will know that Benjamin Graham wrote this originally in the 50s and then revised it up through the 70s several times. I want to say this is the 7th edition. I'm not totally sure on that. Anyway, something like that. And the way Benjamin Graham wrote was very old-timey, and it's great information, but it's also a little hard to read. Something I found super valuable for this book is the commentaries written by Jason Zweig, and he is alive today, and he is a very well-known stock market writer. So, the commentary to the first chapter. Also, after every chapter, there's commentary, chapter commentary. So, this little part that's talking about brokers, it says, "Why do you suppose the brokers on the floor of the New York Stock Exchange always cheer at the sound of the closing bell, no matter what the market did that day? Because whenever you trade, they make money, whether you did or not. By speculating instead of investing, you lower your odds of building wealth and raise someone else's." Right here, Graham is really enunciating how really he is not happy with the idea of speculation, and he is obviously a well-known investor. So a lot of the time when he talks about speculating versus investing, he's talking down to speculation and talking up to investing, which, I agree with. And then it says, Graham's definition of investing could not be clearer. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Note that investing, according to Graham, consists equally of 3 elements. 1, you must thoroughly analyze a company and the soundness of its underlying business before you buy its stock. As Peter Lynch would say, know what you buy. 2, you must deliberately protect yourself against serious losses. Warren Buffett talks about, and many other value investors talk about, how if you can avoid losses, the upside will take care of itself. 3, you must aspire to adequate, not extraordinary, performance. What comes to mind for me when I read this is early on in my investment journey, not really knowing what I was doing, finding some ideas that sounded like sweet ideas and then I could make a lot of money, and look back on those and some of those are down 90% plus. So ouch. Make sure you do not aspire so much for extraordinary performance, although obviously it would be nice if you get that, but really focus on downside protection. Also, if you guys would like to hear a little bit about that experience and what that was and my thought process through that, make sure to leave something down in the comments and I will address that if there's interest. A little bit more from this section of the book. An investor calculates what a stock is worth based on the value of its businesses. A speculator gambles that a stock will go up in price because somebody else will pay even more for it. This is commonly referred to as the greater fool theory. So you buy something and you're just hoping some fool greater than you will pay more for it, and therefore you profit from them being a greater fool. Greater fool theory. As Graham once put it, investors judge the market price by established standards of value, while speculators base their standards of value upon the market price. For a speculator, the incessant stream of stock quotes is like oxygen. Cut it off and he dies. For an investor, what Graham called quotational values matter much less. Graham urges you to invest only if you would be comfortable owning a stock, even if you had no way of knowing its daily share price. What pops into mind here is business buying, because when you buy a stock, you're really just buying a business. You're buying a piece of a business. Now, this makes a lot more sense to me now, reading this again, as I have learned a bunch about business and finance and investing. And one big thing that pops in my head is Codie Sanchez. If you guys know who Codie Sanchez is, she is at Unconventional Acquisitions and ContrarianThinking.co. I will leave a link in the description for you guys to check her out. I am on her newsletter and I love her content. She's also on YouTube and other places and social as well. So something about Codie that she talks about is buying boring businesses that cash flow. An idea that pops in my mind here is buying a laundromat. This is something I'm a little interested in. I haven't really pursued it, but it's an idea possibility for the future. But where Graham is talking about, you should be comfortable owning a business even if you can't check the daily share price. So a lot of people get very obsessed with checking the price of stocks, see whether they're up or down, which honestly is pretty addicting. But hopefully you don't get too attached to it. But with this whole not worrying too much about the stock price, I think of, for example, buying a laundromat. If I could not check the price of said laundromat daily, yet I was able to buy in at an attractive price that protects me on the downside. Say, for example, I could buy a laundromat at 3 times earnings, which is pretty typical as long as the market isn't too hot, like it was, I want to say 2020, 2021, things were pretty spicy in that world as everyone was making money and people are just buying hand over fist. Less so on laundromats, but just kind of general market sentiment. But say you were to buy a laundromat for 3 times earnings. You don't really care whether the price is this or that. Of course, you don't really have a daily quoted price, but if someone else is willing to pay more, kind of who cares? You're cash flowing in the meantime. You own this company and you'll get all your money back within 3 years. And that's a pretty attractive valuation. So that's what pops into my mind with not being able to check the daily price. You know you bought something, you know it has great value for the price you paid, and what other people are shouting at you doesn't really matter. Unless it's a ridiculous number, then you might pay attention. So anyway, that was a little bit on the Intelligent Investor. Hopefully you guys liked that. If you got value, make sure to let me know, hit like and subscribe, and let me know if you like more of these. Obviously, I have a lot more tabs, and the book is just chock full of great content, so I love talking about it, and let me know what you think. Also leave this down in the comments if you guys want to check out the book. And yeah, thanks for sticking around. See you guys.